with with 55 members from 13 countries across the region, which transcend geographical borders to create the magic of EO, alongside EO Kenya, EO Uganda, and EO Lebanon, are elated to introduce Morgan Housel to EO members from across the region. Thank you for joining us tonight for what will be an exciting and eye-opening conversation. In order to keep the session interactive as possible, I'm asking everyone to turn on your cameras so that we can be a dynamic and energizing audience for Morgan. It's also wonderful to see our friends and from around the world. We will have time for questions. If anything comes to mind during the session, please put your questions in the chat box, and Alex, Nicola, and myself will do our best to moderate it. Our speaker tonight, Morgan Housel, is the author of The Psychology of Money. Despite selling over 1 million copies, the book failed to make the New York Times bestseller list, and Morgan will tell us why. Tonight, and through the book, Morgan shares timeless lessons on wealth, greed, and happiness, exploring the strange ways in which people think about money through 19 short stories. We are often taught about personal finance, theoretically. In reality, most decisions are made around a dinner table or in a meeting room, where personal history, our unique worldview, as well as ego, pride, marketing, and the odd and often misplaced incentive are all scrambled together. So a quick question for you all. What does your relationship with money feel like at the moment? Nicola, can we just put the poll up? I'm going to give you guys about 30 seconds to answer that question so Morgan gets a sense of what the audience feels like tonight. So you got about 9 seconds to go. If you haven't had a chance to answer, drop your answer in there. And if not, we will work off what we have. But with about 30% of people answering, we're looking at about an even split of good and bad relationships with money. It's great that as entrepreneurs, we're not asking the question, what money? Nicola, I think we're good to go. And it's great. So we can just share the results of that very briefly.
Cool. So we had 26 responses on the poll. Most people said that their relationship. Okay, so what I'm getting here is most people here are liars, because most people said that the relationship with money is good, and only 27 people, going down to 26 people, 27%, sorry, said that what money? So interesting results there.
Great, Nico, thank you for sharing. Morgan, you get a sense of kind of who's in the room today. I would have said what money if I had an opportunity to answer that question. After this evening's event, we hope you'll become more aware of how your psychology can work for and against you, and hopefully emerge with a better relationship with money, empowering you to make smarter financial decisions for you, your family, and your business for years to come. Morgan, thank you for joining us all the way from Seattle. We know it's early. Over to you.
Well, thanks so much. Thank you for having me. It's good morning for me, good evening, afternoon for you, middle of the night. Who knows where everyone is right now? But thank you for coming, and thank you for having me. I'm going to share my screen right now because I have some slides to share with everyone. So there we are. And what I want to talk to you about today is the psychology of money, which means I'm not going to talk about where the economy is going to go next or what the stock market might do next. I've honestly never been interested in that topic. But I've always been interested in just what's going on inside of people's heads when they think about money and when they think about risk and greed and fear and opportunity, those kind of topics. And I want to start today with a story of two investors, neither of whom knew each other. They never met each other, but their paths crossed in a very interesting way over a decade ago. The first is an investor named Grace Groner. And Grace Groner was born on a farm just outside of Chicago in 1910. And she had a really hard life. She had a difficult life. She was orphaned as a child. She never married. She never had kids. She never went to school. She lived in a one-room house for her entire life. She worked as a secretary for her entire career. Like, she was, by all accounts, for those who knew her, she was a lovely woman. She was a great woman, but she just had a very difficult and kind of understated life. And Grace Gronder died in 2010. She was 100 years old when she died. And when she died, she shocked everyone who knew her, who learned that she left $7 million to charity. And everyone who knew her said, where did this orphaned, humbled secretary get $7 million from? And they dug through her accounts, they dug through her paperwork, and they realized that there was really no secret here. There was no inheritance, there was no lottery winnings, it was nothing like that. All she did is she took what little money she could save from her job as a secretary, she invested it in the stock market, and she left it alone for 80 years. And that was it. That's her whole story. The second investor I want to talk to you about today is a guy named Richard. And Richard had almost the exact opposite upbringing of Grace. He was born into a very wealthy family. He went to Harvard. He got his MBA from the University of Chicago. He went to work on Wall Street in the early 1980s, and he honestly became, like, without exaggerating, one of the most powerful men in all of global finance. He was a vice chairman of Merrill Lynch. He ran one of their largest divisions. He was so successful that he retired from Wall Street in his 40s to become a philanthropist. That's how much money he made in his career on Wall Street. And now, 2 weeks after Grace Gronder died, and after Grace Gronder left all of her money to charity, Richard filed for personal bankruptcy. He told the bankruptcy judge that the financial crisis of 2008 totally wiped him out. He had no income, no assets, absolutely nothing left, to such an extent that his only ability to buy food for his family was selling the furniture out of his house. And now the purpose of those two stories is not to say, like, hey, you should be more like Grace and less like Richard. That's not bad advice, but that's not the point here. What I think is so interesting about those stories is that there's no other industry in the world where those kind of stories are even possible. Like, there's no other industry where somebody with no education, no background, no experience, no connections, no resources can massively outperform somebody who has the best education, the best background, the best experience. That does not happen in any other field, but it does happen in investing, and it happens fairly often. And what that shows, I think, is something that is so important that we overlook when we're dealing with money and talking about investing, which is that doing well with money is not about what you know. It's not about how smart you are. It's not about where you went to school. It's not about your access to inside information. That's actually not what makes the biggest difference. Doing well with money is overwhelmingly about how you behave. And the thing that's interesting about behavior is that behavior is hard to teach, even to very smart people. You can't summarize behavior in charts and formulas that you can memorize. It's not a data-driven thing where you just need a fast computer. It's this, like, soft, mushy topic. And so it tends to get ignored when we're teaching money and teaching investing, even if it's literally the most important topic that exists. So what do we do about that as investors, as people dealing with money? Since behavior is so hard to teach, I think the only way that you can actually deal with it and learn about it and wrap your head around it is with stories. Stories of real people who are dealing with uncertainty and risk and opportunity and greed and fear. These real topics that hopefully you can empathize with, wrap your head around, so that we can all understand the behavioral side of money, the psychology of money, in a little bit better way. So what I want to do with you now is share with you 4 stories, none of which have anything at all to do with money or investing. But all of them, I think you'll see, have a very clear takeaway about how we can think about money and investing and the behavioral side of money in a more practical way. So the first story I want to share with you today is that you can be wrong half the time and still do great. And like I said, this story has nothing to do with investing. I want to tell you a story about the brain development that happens in newborn babies. And for those of you who have kids, you will know that the amount of growth that takes place inside of a newborn child's brain in the first few years is extraordinary. Just the amount of learning that takes place. The average child is born with about 100 billion brain neurons. And each one of those neurons has about 3,000 synaptic connections, which are these connections to other neurons. It forms this web of intelligence when you are born. Maybe you were born, that web of intelligence in your brain looks something like this. By the time the average child is 6 months old, that's increased from 3,000 to 6,000 synaptic connections. So just a lot of growth that's taking place, forming this web of intelligence in your brain. By 2 years, that's increased from 6,000 to 10,000 synaptic connections. So just exponential growth, where you're forming all these connections in your brain, learning about how the world works. And then after 2 years, something very interesting happens, which is that the number of connections in your brain does not just peak and plateau, it starts to decline. And it declines pretty rapidly. By age 4, the average child has already lost 1/5 of the synaptic connections that they had at age 2. By age 6, they've lost about 1/3 of what they had at age 2. This keeps on going all throughout your childhood, into your early adolescent years, even into your early adult years. But by the time the average person is 25 years old, they have lost half of the synaptic connections in their brain that they had at age 2. Why does this happen? What's going on here? Well, it turns out that a lot of the learning that takes place in the first 2 years of your life is learning that is redundant, that is unnecessary, that is just not very practical for the real world. Sometimes it's wired in your brain in a very inefficient manner. Sometimes it's completely miswired in your brain. There's some evidence that particularly in the first few moments of a newborn child's life, that some babies can hear colors and smell sounds because the part of their brain, these connections in their brain that processes that information is totally miswired. And so you go through a lot of the early years of your life shedding and getting rid of these inefficient, unnecessary connections in your brain. But what's really important here is that even though what's going on inside of your head is loss and destruction, and you're losing connections in your brain, you're still getting smarter. A 4-year-old is way smarter than a 2-year-old. And a 20-year-old is way smarter than a 4-year-old. But this idea that you can lose connections in your brain, it's loss and destruction, even though you're getting smarter, is not very intuitive. Because you can imagine if you were a parent and you could look inside of your child's brain every morning and see that you had fewer connections than the day before, you would panic. You would say, this doesn't feel right. This can't be how it's supposed to work. I need to make an intervention. Something seems wrong here. Even if that's the normal path of growth over time. So that idea that something can loop, that you can have chaos and loss and destruction, even though you're getting better and improving over time, is not very intuitive, but we see it in a lot of fields. And one of the fields we see it very often in is in investing. I'll show you what I mean. What this shows is the Russell 3000 stock market index, which is just an index of 3,000 American companies, a stock market index going back to the 1980s. And this is a really good return, average annual returns of about 12% per year. This is like as good as it gets for a large nation stock market. This is a good return in the stock market. But this index that's made up of 3,000 individual companies, if you actually look inside of it and see how those individual 3,000 companies performed during this period, you get a completely different view. You'll see that the median stock in this index underperformed the average by 54 percentage points. 40% of the companies in this index lost money over this 40-year period. The vast majority of those lost all of their value. They went bankrupt. They went out of business, almost 40% of the companies in the index. Virtually all of the return comes from 7% of companies that had extraordinarily high returns. So here again, you start with something that's done well over time, the picture of success. But then you actually look at what went on inside of this over time. And it's a constant chain of chaos and loss and destruction. And this has a big impact on how we think about volatility in the stock market too. This is the S&P 500 in the United States, our largest stock market index, going back to its inception in 1957. And this is like the picture of success for a large nation stock market. If we can like repeat this over the next 80 years, that's as good as anyone can hope for. But this I want to show you, that's when the stock market was down 5% from its previous all-time high. That's when it's down 10% from the previous all-time high. And that's when it's down 20% or more from the previous all-time high. So you start with an index that's done so well over time, such good performance, but then you layer on what actually happened during this period, and it's a mess. You get a totally different view. And what's important is that in every one of the bars on this chart here, you have investors all over the world who say, this doesn't feel right. This feels wrong. Something feels broken. I need to make an intervention. And so they sell. And they think they're doing themselves a favor. They think they've like uncovered a stock market that doesn't work anymore for the first time. Even what they're experiencing is just the normal path of growth over time. And this is accentuated if we're talking about an individual stock. This is Netflix stock from 2002 to 2018. I just grossly cherry-picked the best returns from any company that I can think of. You made 500 times your money during this period. This is like truly as good as it gets if you're a stock picker. But these are the losses, the drawdowns that you had to endure, the volatility that you had to endure to achieve those returns over time. And this is why the percentage of investors who can hold a stock like Netflix for 16 years rounds to zero. It's just not intuitive to think that on your way to earning 500 times your money, you're going to lose 70% of it twice. And you're going to lose half your money on 5 separate occasions. That's just not intuitive, even if that is actually the normal path of growth over time. That dealing with volatility and dealing with uncertainty is the price of admission, the cost of admission to doing well over time. One of my favorite quotes is from Napoleon, who was once asked the definition of a military genius. And Napoleon said, "A military genius is the man who can do the average thing when everyone else around him is losing his mind." And I think it's the exact same in investing. That doing well in investing is not about making great decisions. It's about consistently not screwing up and consistently not reacting to the chaos and the loss and the destruction of the short term that is always around us and is always kind of pulling at us, and not reacting to that in a way that's going to pull you away from a long-term investing strategy that will earn the highest returns. So that's the first story for you today. The second story is that timing is meaningless, but time is everything. And this too is a story that has nothing to do with investing. I want to tell you a story about this moment right here. Most of you will recognize what this moment is. This is the first flight of the first, this is the first second of the first flight in human history. December 17th, 1903, the Wright brothers and Kitty Hawk. And it's hard to overstate how important this moment was for the world, because the airplane changed everything in the world after this. It completely revolutionized not just transportation, but communication and geopolitics. It started world wars, it ended world wars. Like everything in the world was different after the airplane came into use. And the amazing thing about this moment right here is that you don't need any scientific knowledge, any scientific background to understand how big a deal this is. This is not like mapping the genome where you need to be an expert to kind of wrap your head around what it means. This is just a man flying through the sky for the first time. And so even if you were a child watching this at the time, you could understand that this was a big deal, that this was a big deal that people were flying now. So you can imagine how exciting this moment was, and how people all over the world were writing stories in newspapers about how the world was changed forever now that people could fly in an airplane. Except that's not at all what actually happened next. This is the front page of the New York Times on December 17th, 1903, the day of the Wright brothers' first flight. And it's tiny print, but you can take my word for it. There's no mention of the Wright brothers in there anywhere. This is the next day, December 18th, no mention anywhere. And the 19th, and the 20th, and the 21st, and the 22nd, there's no mention anywhere in here about what the Wright brothers were doing, that we had finally flown an airplane for the first time. No mention anywhere in our largest newspaper. This went on for weeks. It went on for months. It went on for years. 2 years after the Wright brothers first flew, the New York Times did an interview with a German hot air balloon tycoon here. And they asked this hot air balloon tycoon, would humans ever fly in an airplane? Because a lot of people were trying back then. And what he said at the time was, quote, "In the very, 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 very far future, there may be flying machines, but not now, not now." Again, that's 2 years after the Wright brothers' first flight. And the largest newspaper in the country did not even know that they had done it yet. One of the craziest things about the invention of the airplane is that after the Wright brothers first flew for the first time, no one paid any attention to it. No one cared about it. There was, in fact, one newspaper that covered the Wright brothers' first flight. It was the Dayton Herald. The Wright brothers were from Dayton, Ohio. And this is how they covered it. Dayton boys solve problem. I love how it's just like a bunch of silly kids who did a science experiment. It doesn't have any meaning in the world. The editor of this newspaper is a guy named Luther Beard. And Luther Beard was asked many years later why he was the only journalist in the country to cover the Wright brothers' first flight. And what he said was, quote, "I used to chat with them, the Wright brothers, in a friendly way because I sort of felt sorry for them. They seemed like well-meaning, decent enough young men, yet there they were, wasting their time day after day on that ridiculous flying machine." So the only newspaper in the country to cover this incredible event did out of sympathy for these poor kids. Now, after Kitty Hawk, where the Wright brothers first flew, they went back to Dayton, Ohio, where they're from. And Dayton is a big city. And they were flying like through the middle of town, over people's homes, over people's businesses. David McCullough wrote a great biography of the Wright brothers, and he talks about this period back in Dayton. And he writes, quote, Not one reporter bothered to attend during this time, nor did public interest increase. With few exceptions, there seemed to be no public interest at all. No local excitement or curiosity or sense of wonder over the miraculous thing happening right in Dayton's own backyard. Now, of course, in due time, the Wright brothers got all the credit and the recognition that they deserved, of course. But it took years. It took them about 5 years to build the airplane, and then another 5 years before anyone was paying any attention to it. And this is so important because if you think about the traits of successful entrepreneurs, you think about things like creativity and ingenuity, your marketing ability, your engineering ability, those kind of things. Rarely do you think about patience and time horizon as a competitive advantage. For the Wright brothers, it absolutely was. Or to the extent that we do think about patience as a competitive advantage, we often massively underestimate how much time is needed to put the odds of success or the odds of recognition in our favor. And that is also true with money. I'll show you what I mean. This is Warren Buffett's net worth over the course of his life. From age 14, when he had about $5,000 in the bank, to today, when he has $100 billion and he's about 90 years old. This is how it's played out over the course of his life. And something that should stick out from this chart that is so astounding to me, no matter how many times I think about it, is that 99% of Warren Buffett's net worth was accumulated after his 55th birthday. 97% came after his 65th birthday. That's just how compounding works. It's not something that takes place over a couple years or even a couple decades. It's a lifetime endeavor. And this is so important because if Warren Buffett had retired at age 60, like a normal person might, you would have never heard of him. He never would have become a household name. He never would have achieved a tiny fraction of what he has. The reason he is so wealthy is because he has been a good investor for 70 years. That's the time is what's made all the difference. And this is so important because we spend so much time in the industry trying to answer the question, how has Warren Buffett done it? How has he achieved what he has? And we go through all of this in-depth analysis about how he thinks about business cycles and valuations and management teams, which are important topics. But we know literally 99% of his success is just the amount of time he's been investing for. And this is true for us mere mortal investors as well. This is going back to the 1870s, the maximum and the minimum annual returns you could have earned in the US stock market by holding period. So if you held stocks for 1 year or 5 years or 10 years, what's the best you could have done annually and the worst you could have done annually? That's what this shows. And something that should stick out here is that it is not until between 10 and 20 years that every holding period finishes with a positive return. Not a good return, just not losing money after inflation. It's between 10 and 20 years. And this is important because if you ask most investors, are you a long-term investor? Most investors will tell you yes. Most investors think they are long-term investors. But then if you ask them, what does long-term mean? What's the definition of long-term? A lot of investors will tell you 1 year is the long-term. Maybe 5 years is the long-term. 10 years definitely feels like the long-term. Even if we know historically a pretty good definition of long-term, the definition being just not losing money after inflation, is something between 10 and 20 years. So we just massively underestimate how much time is needed to put the odds of success in our favor. I think we need to remind ourselves as investors that when progress is measured generationally, results should not be measured quarterly. And that this compounding is never intuitive. So almost all investors underestimate how much time is needed to put the odds of success in their favor. And it's such boring advice and basic advice, but there is nothing more important and more powerful than exists in this industry than just increasing the amount of time you are investing for. Again, you're not going to get anyone's attention with that advice. It's so basic, but there is truly no more powerful lever that exists in finance than time. And that is the single biggest advantage that anyone can put in front of them to have for them to increase their results. So that's the second story for you today. The third story is getting the goalpost to stop moving. This might be one of my favorites too. And this story, of course, has nothing to do with investing. I want to tell you a story about this guy right here, Stephen Hawking, who was, without exaggeration, one of the smartest humans to live and walk this planet over the last 100 years. Stephen Hawking was just an absolute genius in his understanding of astrophysics and how the universe works, just an absolute savant. And a quirk of Stephen Hawking's, of course, is that he had a motor neuron disease and he was paralyzed from head to toe. He had no control over his body. He spoke through a computer, of course. And he was not born like this. He was born a perfectly healthy, able-bodied child. He grew up as an athlete. He rode crew during college. And he became afflicted with this disease at age 21 and kind of lost control over his body after that. Now, a few years before Stephen Hawking died, the New York Times did an interview with him. And during the interview, he started talking about how happy he was and about how great his life was and about how much he enjoyed his work, just how happy he was in life. And the New York Times asked him an interesting question. They said, "Are you always this happy?" And his answer was very interesting. He said, quote, "My expectations were reduced to 0 when I was 21. Everything else since then has been a bonus." And this idea that how much benefit you get out of life, how much joy you get out of life, is not necessarily about your circumstances. It's your circumstances relative to your expectations that makes all the difference in the world. That's a really important point. And I think it impacts a lot of areas in life, including, if not especially, how we think about money. I'll show you what I mean. If you ask Americans, when was the greatest time economically in the history of this country? They overwhelmingly point to one era, one decade, and that is the 1950s. The 1950s are what we remember in America as like the golden age of economic prosperity, when anyone who was willing to work hard could have a good job, good income, dignified life. This is what we remember. And this is not just hindsight. We knew it at the time that the 1950s were an amazing period economically. Life magazine, where I got this picture, they wrote in 1953 that, quote, "The present and immediate future seem astonishingly good. The country has just lived through was economically the greatest year in its history." So we remember today, and we knew back then, that the 1950s were like as good as it gets economically, way better than any period since. This is how we remember it. And what's so interesting about this nostalgia that we have from the 1950s is how easy it is to prove with numbers that it's just not the case that we were better off back then. And by almost any metric, we are so much better off financially today than we were back then, but we remember it so much greater, being it so much greater back then. The average household income, the median household income adjusted for inflation in 1955 was about $29,000 per year. By 1965, that was about $42,000 per year. And in 2020, last year, it was about $64,000 per year. So the average American family has twice as much income during the glorious 1950s, has twice as much income today than they did during the 1950s. And part of this is because of the rise in the number of females who are working, but that's only part of it. Average real wages, hourly wages, are double today what they were in the 1950s. And you keep going on down the list of what it was like during this golden age during the 1950s. The average new house was 37% smaller back then than it is today. The average new house in the 1950s had 1 bathroom for 4 people. Today we have 4 bathrooms for 2 people. It's completely flipped. Food took up an average of 29% of an average household's budget in the 1950s versus about 13% today. Workplace deaths were 3 times higher back then than they are today. And half of men over age 65 were still working in 1950 compared to about 23% today. The average American in the 1950s worked until they died. That was the expectation, that was the reality. And the idea that, like we have today, that an ordinary person can have a dignified retirement just did not exist back then. So you keep going on down the list of what it was like during the supposed golden age. And we are so much better off today by almost any other metric. So then the question is, why do we have this nostalgia for the 1950s? Why do we remember it as being such a better time back then, even if we're better off today? And there could be a lot of answers to that question. But one of the most important, I think, is this. The 1950s were a really interesting time in the US economy and for most Western nations because there was very little wealth inequality. The gap between rich and poor was just a fraction of what it is today. A lot of that was just an echo from World War II about how we managed companies. The top marginal tax rate was 91% in the 1950s. So you did not have CEOs who earned 1,000 times what their workers earned. You didn't have athletes making $50 million a year. You didn't have hedge fund managers who are accumulating billions of dollars. It just did not happen in the 1950s. And so because of that, because there was very little wealth inequality, it was very easy for your average ordinary household to keep their expectations in check. Their definition of a good life, their social aspirations for the kind of material possessions that they wanted to have, it was easy to keep your expectations in check because there were not a lot of very wealthy people who were inflating your aspirations. So the lower incomes felt great because everyone else earned a low income. And the smaller homes felt fine because everyone else lived in a small house. Going camping for vacation seemed adequate because that's what everyone else did. It was just an era where keeping your expectations in check was very easy. And that's why I think people felt like it was a better time back then. Your expectations did not grow faster than your income. And the takeaway from that today, for all of us in this era, no matter how much money we make, is that if your expectations grow faster than your income, you will never be happy with your money. This is like a golden rule of finance. It has to be obeyed no matter how much money you earn. All wealth is a two-part equation. You need to grow your income, grow your assets, and then keep that income and assets relative in check to your expectations. And it's so easy to ignore the latter half of this equation. We spend all of our time thinking about money, thinking about how to gain more of it, grow your income, grow your assets, which is great. That's an important topic. But none of that matters unless you also do the second step, which is keeping your expectations in check. And there are so many people who are lucky enough to have a rising income, a rising net worth, but their expectations rise just as quickly and they're never happy. That's the whole story of most growth over the last 70 years. We got way richer around the world, but our expectations grew even more and we feel worse off because of it. It's the craziest thing. And I'll show you an example of what happens of when you really don't keep your expectations in check. Most of you who know who this guy is, Bernie Madoff, the biggest financial fraudster of all time. He started a Ponzi scheme that stole $20 billion from his investors. He's the biggest financial criminal of all time. And an incredible thing about Bernie Madoff's life that was kind of ignored in his life story is that if you go back to the 1980s, before his Ponzi scheme began, Bernie Madoff was earning from the legitimate, non-fraudulent side of his business, was earning $30 million per year. Again, not from the fraud. His real legitimate business, he was earning $30 million a year. He was honestly one of the most successful businessmen in the entire world before he started the fraud. And what's astounding to me about this is that despite that success, despite that wealth, he wanted more so badly that he was willing to start this fraud that ruined everything. And now look, if you are broke and you have a starving child at home and you go out and rob a grocery store, that I can kind of wrap my head around. That I can kind of understand. But if you are this wealthy and you want more so badly that you're willing to take this much risk, start this fraud, that to me is astounding. And of course, this is an extreme example. Madoff is a psychopath. But I think we all have something of this in us. That if we're lucky enough to have a rising income, but our expectations rise just as much, we're never going to be happy. And that the expectation side of managing your money is just as important, if not more important, than the income and asset side of it. Several years ago, two famous authors, Kurt Vonnegut and Joseph Heller, were having lunch at the house of a hedge fund manager in the Hamptons. And Kurt Vonnegut turned to Joseph Heller and he said, "Joseph, do you know that the owner of this house earns more money per month than you have earned in your entire lifetime?" And Joseph Heller said, "That might be true, but I have something that the hedge fund manager will never have, and that is enough money." And I think this word, enough, is probably the most important word that exists in all of financial planning. And everyone's definition of enough will be different. But if you don't go out of your way to try to define what is enough money, enough risk, enough work, enough time away from your family, if you don't go out of your way to try to define it, you're likely to learn about it the hard way when it's too late, when you've taken too much risk, when you haven't spent enough time with your family. When it's too late is when you'll learn about it unless you go out of your way to define it yourself. So it's the third story for you today. The last story to share with you today is that risk is what you don't see. And this story too has nothing to do with investing. I want to tell you a story about this guy right here. This is Harry Houdini, the famous magician who did most of his work in the United States about 100 years ago. And Houdini was known for his escapes. He was an escape artist. He would tie himself up in chains here and he would throw himself in a river and he'd escape. He was the best in the world at it. But he had another trick that he did during every show. that he wasn't very famous for, but the audiences loved it. And that was at the end of every show, Houdini would invite the largest, strongest man on the stage, and he would tell them to punch him in the stomach as hard as he could. His claim to fame was that he could flex his stomach in a way that could absorb any guy's punches, no matter how big he was. So the guy would come on the stage and Harry Houdini would punch him in the stomach and he wouldn't even flinch, and people loved it back then. But one day after a show in 1922, Harry Houdini went back to his dressing room and he invited a group of college students back there to meet him. One of the college students was a skinny little 19-year-old kid named Gordon Whitehead. And Gordon Whitehead walked up to Harry Houdini and he started punching him in the stomach as hard as he could. He didn't mean any harm. He wasn't trying to pick a fight. He thought he was just doing the trick that he had just seen on stage. But Harry Houdini was not prepared to be punched. He didn't know he was about to be punched. And all of a sudden, he was doubled over on the ground in a lot of pain. He explained to Gordon Whitehead that the trick only works if he's prepared. And since he wasn't prepared, he just kind of got sucker punched here. Gordon Whitehead apologized profusely. He said, "I'm so sorry." But Harry Houdini went to bed that night, doubled over in pain. He woke up the next morning. He couldn't even get out of bed. He was in so much pain. His appendix had ruptured the night before, almost certainly from Gordon Whitehead's punches. And Harry Houdini died later that day. This is how he died. And what's astounding to me about how Harry Houdini died is that Houdini was like the world's foremost authority at surviving big risks. Like tie himself up in chains and throw himself in a river, that he can survive no problem because he's prepared for it. He has a plan for it. The one thing that he cannot survive is just a skinny little college kid's punch that he was not prepared for, that he did not see coming, that was a surprise to him. And what that shows is something that's so important in a lot of areas in life, which is that how risky something is depends on whether you're prepared for it. Not how much damage you think it can cause, not how big a risk you think it is, just whether it's a surprise or not. And how much have we all learned that over the last 2 years with COVID, in the economy, with our money? That the biggest economic risk is what no one's talking about. Because if no one's talking about it, no one's prepared for it. And if no one's prepared for it, its damage is just amplified when it arrives. That's the biggest risk, the biggest lesson I think that we have seen from COVID over the last 2 years. And I think if you look historically, this is always the case. And I'll give you an example of this that's really impacted us financially over the last decade. We spent the better part of the last decade talking about what is the biggest economic risk. That's the topic that takes up 90% of the oxygen in the financial industry. What's the biggest economic risk out there in front of us? And we tend to personify these risks. We like to attach a face to these risks. So in America, we asked, was this guy the biggest risk? Was it former President Barack Obama? Was it the tax hikes of 2013? Was he the biggest risk? Was it this guy? Was it Ben Bernanke, the former chairman of our central bank? All the money printing after the financial crisis, was he the biggest risk? Ooh, was it this guy? Was it Donald Trump? All the crazy policies in the last 4 years, was he the biggest risk? This is the topic. These are the questions that took up 90% of the oxygen in the financial industry. And the irony about these three guys here is that we now know in hindsight that the answer to the question, who is the biggest risk? What's the biggest risk to the economy? Is none of these three guys. It was this guy here. It was a virus that no one was talking about. It was not in any economic outlook, no analyst forecast. No one was talking about it until the moment it arrived, and tens of millions of people lost their jobs. The biggest risk by far is what we did not see coming. The biggest risk is what no one was talking about. And again, I think if you look historically, that's always the case. It's always the case that's like this. The risks that we read about in the newspaper are things like trade wars and next quarter's profits and budget deficits and elections. That's what people talk about all day long. It's in the newspaper. And it's not that these things aren't risky. It's that they're not surprises. Everyone knows about these things. Maybe you don't know who's going to win the election, but you know there's going to be an election. It's not a surprise to anyone. If you look historically at what actually moves the needle, what actually is the biggest economic risk, it's things like COVID-19. And Lehman Brothers couldn't find a buyer in 2008 that started the global financial crisis. 9/11 terrorist attacks, Pearl Harbor that dragged America into World War II. That, for someone like me, that's the biggest risk to the economy. That's the biggest risk to my investments. And the common denominator of these events is not that they were big, it's that they were surprises. It's that no one saw them coming until the moment they arrived. And I think that idea that risk is what you don't see can be pretty disheartening. Like that could be kind of scary, that the biggest risk that's out there in front of you is just whatever we can't even fathom or imagine today. But it's always been the case. Carl Richards has a great quote. Carl Richards is a financial advisor who I admire. He has a great quote where he says, risk is what is left over when you think you've thought of everything. That's what risk is. And I think there's a couple ways that we can manage that reality in this world. The first is the idea of having expectations instead of forecasts. They're actually two very different things. And I'll tell you the difference between the two. If I were to say, hypothetically, the next recession will occur in June of 2023, I'm just making that up. That's a forecast. But if I were to say, historically, there have been an average of 2 recessions per decade, and I expect that to be the case going forward. I don't know when they're gonna occur. I don't know what's gonna cause them, but 2 recessions per decade, that's my baseline estimate for what to expect going forward. That's an expectation. It's totally different from a forecast because I'm not pretending that I know when or what is gonna cause something. It's just have an expectation of volatility and risk in the future. I think it's the best way that we can think about risk in the world where risk is what you don't see coming. The second thing is understanding the difference between getting rich and staying rich. They're two completely different skills. They need to kind of be nurtured on their own. Getting rich requires being an optimist, swinging for the fences, taking a risk, being optimistic about the future, optimistic about your own abilities. Staying rich requires almost the exact opposite. It requires like a degree of pessimism and paranoia, and just an acknowledgement that all of history is a constant chain of surprises and losses and setbacks and recessions and bear markets that you need to be able to survive and endure financially for your long-term optimism to actually stick around long enough to work. And so if there's a common denominator of those 4 stories today, is that when people tend to think about risk to their money, they usually think about what's going to happen to them. What's the stock market going to do to me? What's the economy going to do to me? I actually think a much better way to think about risk is just what we do to ourselves. It's our own biases, our own misconceptions. That's what does the biggest damage and poses the biggest risk to our money. And that's actually a pretty optimistic realization because, of course, you have no control over what the stock market is going to do next. And you have no control over what the economy is going to do next. The only thing you can control with your money is your own behavior. And when you realize that behavior is by far the single most important aspect of successful money management and investing, that's actually pretty optimistic. So I want to end with you today with a quote from an investor who I admire who says, people do not get what they want. Whoop, did we lose it? I'll just say it to you. People do not get what they want or what they expect from investing. They get what they deserve. It all just comes down to how you behave. So thank you for listening to those few stories. I think we have some time now for some Q&A, and I'm happy to talk about anything. So thank you again for coming. Thank you for listening, and it's an honor to be here.
Great, Morgan. Thank you. Thank you very much for that. Thanks for the kind of engaging kind of perspective from stories related and not related to finance. I'm going to jump straight into questions. There was one that was posted on the chat, which was, don't you think so much has changed in today's age where information is more decentralized, company valuations are different, and crypto leaves more questions perhaps than answers? And that was when we were talking about valuations and the stock market.
I think the answer to that is yes. I mean, it's always the case that there's a great quote that I love from Voltaire, where he says, history never repeats itself, but man always does. And the takeaway from that is like, the global economy is always changing. It always has changed. And we can't just look at history and look at the data from like what valuations worked in the 1950s and compare it to today and expect history to be a map of the future, because it's not. But people's behaviors never change. How people respond to greed and fear and risk and those kind of things, those are enduring just characteristics of who we are as people. So I think when you talk about the technical details of how the stock market works and valuation techniques, those kind of topics, the world's completely changed today. It's changed in the last 5 or 10 years. It's changed in the last 2 years with COVID. That makes like how the world works today, like not comparable to what it was 2 years ago. That's true. To me, that is less important though than the idea that the behaviors of how people think about greed and fear and risk never change, and that we can study history and study how people responded to greed and fear and learn something that is enduring that will be part of our future. I think those betting on things that never change and focusing on the behaviors that never change that's how you get around the idea that yes, the world is always evolving. So how can I learn something that is enduring? It's focusing on the behaviors instead of the technical aspects of it. So I'll give you just one example of like how the technical aspects of valuation have changed. If you look at the US stock market, the S&P 500, that did not include any banks until I think 1974. And it did not include any technology companies really until the 1990s. So if you were to compare today's US stock market with what it was in the 1960s, you're looking, it's not even apples and oranges. It's like apples and trucks. It's completely different to compare those things. And I think that throws a lot of investors off. And again, I just deal with that change over time by trying to focus all my behavior on what never changes and what I have a lot of confidence will still be relevant 20 years from now as it was 20 years ago.
Thanks, Morgan. There's one more question before I get to that. I have a personal one. Is how did you sell 1 million books and not get on the New York Times bestseller list? I'm super curious.
It's astounding. I've learned a lot about the book industry over the last 16 months or so. And look, here's how the New York Times bestseller list works. They do it by weekly sales. So if you have a book that sells a ton of copies in 1 week, you get on the list. Let's say you have a book that sells 10,000 copies in week 1 and 0 copies in week 2, you'll get on the list. But if you have a book that just sells like a good amount of copies every single week for a year, then in any given year, you're not that special. So my book has sold 1 million copies, but it never made the New York Times bestseller list. But there are books that sold 20,000 copies that did, because they sold all 20,000 in 1 week, kind of thing. So it's a weird kind of quirk to it. That it's not a rigged game. It's just the rules to it. I've come to learn with a lot of these like awards in life. This is true for a lot of different fields and whatnot, that even if something isn't rigged, once you realize like how the winners are picked and whatnot, you start taking these kind of awards less seriously.
Great. Thanks, Morgan. So question from Nuruddin Afjani. I'm a huge fan. I would like you to please tell everyone, how do you invest? What's your investment strategy?
Yeah, happy to talk about it. And I read a lot about this in the book. I'm a very passive investor. My finances are so ridiculously simple. And I write in the book, and this is true, that my entire net worth is a house, this house, a checking account, and some Vanguard index funds. And that's it. That's it. It's really not, I'm not simplifying that. That's really what it is. And the reason I'm a passive investor is important. It's this. I'm not one of the passive investors who says, no one can beat the market, don't even try, like it's not even worth trying. That's not me. I think there are a lot of good, smart investors out there who will beat the market and will earn superior returns. So then the question is, why do I not invest with them or try to become one of them? And there's an important answer to that. And it's this. I want to spend all of my brain power, all of my focus on focusing on endurance. Just how can I actually own the stocks that I do own for the next 50 years and actually hold them for 50 years? Because if you understand compounding, you realize that all that matters is just how long can you stay in the game. Like compounding is just a function of time. And in the equation of like compounding is returns to the power of time, the exponent of time, that makes all the difference in the world. So I want the simplest investing strategy possible, because the simpler it is, the higher the odds that I'll actually be able to stick with it for 50 years. And once you kind of grasp that power of compounding, you realize that the question that you want to answer is not how can I earn the highest returns? It's what are the best returns I can sustain for the longest period of time? And to me, I think what has the highest odds of actually being able to stick with it for 50 years is the simplest investing strategy that exists. And I know that if I can earn average returns for an above average period of time, for the longest period of time possible, for a half century if I can, I'll achieve every financial goal that I have and then some without putting any effort into it. And so I think there are a lot of investors who will earn much higher returns than me this year, next year, over the next 5 years, over the next 10 years. But I think it's higher odds that they won't be able to stick with it for 50 years. And so I think by actually earning lower average annual returns in the short term, I'm actually maximizing wealth in the long term, because it increases the odds that I'll be able to actually do it for 50 years. So that's how I invest my money, and that's why I do it.
Great, Morgan. That's a fantastic answer. Thank you for being so open. Aditya, I'm going to ask you to ask your question out. We're just going to spotlight you for a second. If you can ask your question to Morgan.
Which one? The latest one? Where does
the latest one, please?
All right. So Morgan, where does fun, excitement, and achievement fit into investment? Or do you feel they have no place?
No, it definitely has a place. It's a great question, because here's the thing. Back to what I was talking about in the previous question about endurance. You know, what matters is just how long can you stick with it? Like, one corollary from that is that a subpar investing strategy that you can stick with will beat the perfect investing strategy that you're going to abandon someday. And I think there are a lot of people who really need to scratch the itch of gambling and speculating and day trading penny stocks, if that's what it is. And by saying you shouldn't do that, that's a bad idea, you're pulling people away from what they naturally want to do, and therefore you're increasing the odds that they won't be able to stick with it. And so I think if you are a person who has a strong desire to have fun in the market and to trade and to speculate, and if you were not allowed to do that, you're just going to abandon investing to begin with, I think that's fine. I think that's great. So I think for a lot of these people, if you were to take 10 or 20% of their money and just say, go have fun with that, but we're going to invest 80% of it for the long term, but you can scratch the itch with this portion of your portfolio, I think that's the right thing to do. Now, I love markets. Even though I'm a passive long-term investor, I watch markets all day long. I watch the market. I look at the futures the night before. I really love just how markets work. I think it's fascinating and exciting. So I understand that desire to want to have fun. You know, I don't actually speculate with the money. I'd like just watching it is enough social stimulation for me to get excited about it. But I think markets are fun, and capitalism is amazing. It's like the most incredible learning machine that I think exists on a daily basis that has a lot of frequent feedback to it. So, you know, I think the question then is like, what portion of your money should you quote unquote have fun with? If it's 100%, like that might be getting into trouble. But if you're someone who can say, look, I'm going to invest for the long term with 80% of my money and have fun with 20%, I think that's not only okay, I think that's ideal if it's likely to increase the odds of leaving the 80% alone for the longest period of time.
Great. Thank you, Morgan. Jay, I'm gonna ask you to ask your question.
Yes, Morgan, thank you for your time. Thank you for your energy. Very happy to be here. I happen to have read your book. I've heard your interview on Investopedia a while back. So very nice to hear you. My question is the following. I know you bring a lot of powerful example from history, whether investors or in the investment industry. Why, in your opinion, do wealthy people continue wanting more and more when enough is never enough, like the example of Bernie Madoff? Why does it happen that wealthy people, cross the line and don't know what is enough? Is it the hedonistic culture that judges people but what they have, what they wear? What is, in your opinion, that makes people go beyond ethics, beyond border to keep wanting more and more?
I think so much of it, it's a great question. So much of it is just social comparison. And unless your name is Elon Musk, somebody else in the world is richer than you. And when your definition of success is beating the next guy in front of you, you're never going to win that game. Unless your name's Elon Musk, there's always someone who's getting richer than you. And let's say you have a goal of like, I want a net worth of $100,000. As soon as you get there, you're going to look at people who have 200,000. As soon as you get there, you're going to look at people who have 1 million, and then it's 5 million, 10 million. The example I've used is like, if you are a professional baseball player, the minimum wage you can earn is, I think, $700,000 per year. Now, $700,000 by any definition makes you rich. You're a rich person, but you don't feel that because everyone else on your team is earning $10 million a year, $20 million a year. So you feel like you're poor. It's all just the social comparison aspect to it. And I think in today's world, particularly with social media, when your ability to see other rich people is like unparalleled, and you log on to Instagram and you see people in their Lamborghinis taking their private jets to Bali, like there's so much wealth that's in front of you. It's so easy to just set your expectations of the definition of enough is however much the guy who's richer than me has. That's the definition of enough. And if you play that game, you will never win that game. To me, like the antidote to that, like how you fix that, is moving away from external benchmarks to internal benchmarks. If you only focus on the external benchmark of like, how are other people doing, and anchoring your success to their success, you're never going to be satisfied. It's not until you just focus internally and you're like, where was I 10 years ago and where am I today? Am I meeting my own personal goals? And if the answer to that question is yes, then like, great, like I've won, I've checked all the boxes. It's not an easy thing to do, but I think that's the only way to get around this. There's a financial advisor who I like. He's a friend of mine who says that he has a client who does not care about how his portfolio is performed, like annual returns, how much did I beat the market this year? He has no concern about. The only thing he cares about is, do I have enough money to travel to Europe? That's all he wants to do. That's his only personal benchmark. And I think he had this quote where he's like, leave all the fighting, like the social comparison to other people. I just want to travel. And I think once, like, he's just focused on the internal benchmark. I think that's the only way to kind of break out of that trap. And it really is a trap, because all of us, me, you, everyone, falls for this idea of like, if I can get to this next goal, I'll be happy. And then if we're lucky enough to get to that next goal, you just move the goalpost, and you start, like, your gaze expands, and you just have a new goal. And so in a lot of ways, like globally, that dynamic is great, because that's what pushes people to keep progressing and become better, and new innovations, like new productivity. So a lot of ways it's great, but individually, I think it's a trap. And this is why, definitively, without doubt, the wealthiest people in the world are not any happier than you and I. There's no question in my mind that saying is true. If anything, I think it's the other way around. I think some of the wealthiest people in the world are less happy than you and I, because they know what you and I are blind to, which is that having that much wealth actually does not make you that much happier. It doesn't really change your life, because they have a different set of social comparisons to compare themselves to. And they are unhappy with their wealth because the guy has a bigger yacht than them and he has more private jets than him. It's like that game never ends. So I think a lot about that personally, of just trying to focus on the internal benchmark rather than the external social comparisons.
Jay, thank you for the insightful
Morgan.
question.
Appreciate it.
Thanks, Jay. Eric, tell us more about your thoughts. Eric, you had a question for us.
Yeah, thank you, Ritesh. Hi, Morgan. Thanks for the inspiring talk, and I totally agree with you. Enough is our own barrier. We have to have our own limits. My question to you is: you mentioned about the difference between expectation and forecast, and how can we get prepared for the unexpected? How do we expect the unexpected and finally to get over it?
I think financially, in terms of like the actual thing that you can do with your personal finances, it's this, because like by definition, you cannot define what the unknown risk is. And I guarantee you that the biggest financial risk over the next 12 months, over the next 5 years, is something that you and I and anyone else cannot even fathom. That's always been the case. The only way to deal with that in your personal finances is to have more room for error than seems reasonable. Because if you are only preparing for the risks that you can imagine, that you can foresee, by definition, you are unprepared for the biggest risks that you cannot foresee. And I think most people's finances should be more conservative than they are, because most people are only preparing for risks that they can imagine. And I think you're only doing it right if you have enough cushion in your finances, enough room for error that feels excessive. It's only right if it feels excessive, because that's when you know that you're preparing for risks you cannot imagine. It's like this for my personal asset allocation. If you looked at my net worth, the percentage that I have in cash seems excessive. For someone of my income and my age, it seems like it's way too much. But part of that for me is just like, I want to prepare for the risks that I can't even imagine. If I only have enough cash for the risks that I can foresee for the next 12 months, I'm going to lose every time. So I think that's the only way to deal with it in a practical way, to deal with risks that you can't see, is to have more cushion than seems reasonable. And there's so many companies and so many investors, so many firms, that when the crisis hits, whether it's March of 2020 with COVID or like September 2008 with the financial crisis, when that hits, they think that they are prepared for risks, but then you get a risk that they didn't foresee coming, and they're screwed. They're in so much trouble. And it's only the people that feel overly conservative when things are good that end up having enough longevity to stick around during the hard parts to actually compound for the long term. I think that's the only way to deal with it.
Great. Thank you for that answer, Morgan. Morgan, I'm going to head over to Sandeep Devgan. Sandeep has a question for you.
Morgan. Hi, Morgan. Thanks for the talk. My question is more on, we talk a lot about financial freedom and living a joyful life, but I know you talked about having an internal looking inwards, but it's easier said than done, at least for me. How do you have any tricks or things that you do to kind of keep yourself grounded? For example, one of the things I do is I've told my wife to kind of put everything on a spreadsheet and lock it up and throw away the key. Whatever you want today is not going to change, right? But the more we see, the more we get exposed to, the more we want. Can you talk a bit more on that? How are the things that other tricks that we can do to kind of change our behavior?
You're totally right that it's easier said than done, and this is something that me and my wife think about too, because like I'm just as susceptible to that as anyone else. If there's one trick that I think has helped me, that it's still difficult, but I think it's the context that helps here. It's the observation that no one is thinking about you as much as you are, and therefore your aspirations to have a nicer car, a bigger house, whatever it might be, no one is as impressed with your stuff as you are, because everyone else is thinking about themselves. So you might think like if you have an aspiration to have a really fancy car, that like people are going to be looking at you and be like, wow, that guy's cool. Look at his cool car. They're not. They're thinking about themselves. They're thinking about their own desires to have that fancy car. They're thinking about what their lives would be like if they were in that fancy car. I think once you realize that everyone is concerned with themselves and no one is thinking about you or me or anyone else as much as you are, then you realize you're like, okay, look, I'm in my own little bubble. It's just me and my family. How can I use money to make me and my family happier and really limit my social aspirations, my social ambitions for like waving the peacock feathers and wanting to show everyone else how much money I have? Once you remove that from your life, I think it's easier to have enough. It's easier to start defining what enough is. Once you remove the social ambitions of the signaling to other people what it's like. And so I personally just want to use my money to have independence and autonomy. And I just want to wake up every morning and be like, I can do whatever I want today. And that means like my aspirations for a nicer car, a nicer house, nicer clothes are pretty minimal. They're not zero, but they're pretty minimal. But my aspirations to have autonomy and independence and being able to do what I want when I want, that's huge. And I think once you kind of shifted away from the social signaling to the independence, I think it's easier to start defining what enough is for you. But you're right. I will never admit that it's easy because it's difficult, but I think it's so critical to at least try to move the needle here.
Cool. Thanks a lot.
Morgan, thank you very much for your time. Well, this morning, your time, our afternoon, evening. There have been some great questions that have come in. We want to be respectful of your time. And I've got a couple of minutes over. I think everyone's super interested. For those who haven't read Morgan's book, there are some really great lessons in there about wealth, greed, and happiness. And it's actually a fast-paced book, split over 19 stories. And I know many of us follow a 10-10-10 session in the morning. It's great morning reading. It's super engaging. I hope you guys, for those who haven't read it, I hope you have an opportunity to do so. Morgan, thank you very much. Any parting words for us as we wrap up today's session?
Just thanks again for having me. This was a lot of fun. Hopefully, as we go into 2022, we'll be able to see each other in person around the world. But this is an honor to get to do this. So thank you. I appreciate it.
Great. Well, from behalf of EO MEPA Bridge, EO Kenya, EO Uganda, EO Lebanon, and from our friends and potential EO members, thank you very much, Morgan. Thank you all for joining us. Thanks for the fantastic questions. Thank you guys all for being engaged this evening. I've definitely learned something about my psychology about money. And from the questions that I've read, I get the sense that many of my peers have. So Morgan, thank you very much. Nikhil, Alex, Sanjeev, thank you very much for making everything work like clockwork this morning and this evening. Have a wonderful rest of the week, everyone, and hopefully we'll see you at the next EO event. Alex, I think as we're wrapping up, I think you can share your screen with the next EO event, which is happening in a couple of weeks, about doing business and early stage investing in Africa. But if we learned anything from Morgan today, put your money in an index fund and go and play golf. But if you do want to invest in early stage ventures in Africa, Alex can share a little bit more about a talk we're giving on that. Thanks all. Have a wonderful evening.
Thank you.
So thank you, Ritesh. So we have our next event happening, our last event for December, and it's happening on next Thursday, 16th. It's about doing business in Africa. The flyer is going out this evening, and we hope that you can make it. It is at 4 p.m. Nairobi, GMT +3. And I do not have let me see if I can put up. What I will do, I will send you all the flyer and also invite you by email, this description as well as description of the bios of our speakers. Thank you so much. Over to you, Ritesh.
Great. On that note, thank you all for a wonderful evening. Nice to see everyone again. Looking forward to seeing everybody in person. Good night.
Thank you. Good night.